Hello, everyone. Welcome to the webinar on Decarbonization Darwinism, the existential challenge facing the global chemicals industry. I'm Mike Holman. I'm a SVP and Group Director here at Lux, moderating today's session, which is presented by our Research Director, Anthony Schiavo. We will have some time for questions at the end, so feel free to type any of those into the box on your screen during the presentation. We'll answer as many of those as we can, but if we don't get to yours or you think of something good later, please feel free to email that to questions@luxresearchinc.com. So with that, let's jump into the presentation.
Thanks, Mike. So today we're going to be talking about decarbonization Darwinism. I think everyone is probably familiar with this guy, Charles Darwin, the notable creator of the theory of evolution, which states that under an evolutionary pressure, some individuals will have traits better suited to surviving. Those beings will pass those traits on to their offspring, thus propagating them throughout time and creating new species. And it's this framework that we'll be applying to the chemicals industry today, because the energy transition is an evolutionary pressure that is going to force the chemicals industry to adapt or go extinct. So first, we'll examine decarbonization as evolution. Then we'll use the carbon canvas to analyze the chemicals industry and look at some of the directions players might take. And lastly, we'll talk about the future chemical enterprise and how it might evolve. If you saw our webinar last month, you saw this slide. We are near our limit of the ability to emit further carbon. If we want to keep global warming to just 1.5 degrees centigrade, we only have about 420 gigatons of total cumulative carbon emissions left. This means that we only have about 10 more years at a rate of perhaps 35 gigatons per year. Thus, the energy transition, decarbonization, and moving away from these fossil fuels and combustion is really an urgent issue. We need to get the bulk of the work done in this next decade to buy ourselves enough time for further deep decarbonization. This creates two key challenges for the chemicals industry. The first, which we discussed last month, is the need to access new markets within the energy transition. This is a relatively positive story. We talked about how there's more than $100 billion of new opportunities, everything from pipelines for hydrogen to novel low-carbon concrete. But today, we're going to be focusing on the other half of the challenge, directly decarbonizing operations. This is probably going to be a lot more challenging. And again, this is crucial to everyone within the energy transition, whether you're upstream in the energy space, providing feedstocks to the chemicals industry, or a downstream user of materials and chemicals. The chemicals' ability to decarbonize in the face of this energy transition is crucial. Now, decarbonization is actually really super simple. All you need to do is immediately cease all business operations, and you'll cut your carbon emissions to zero. Of course, that's not really ideal. Beyond the fact that we're all in business, the reality is that the chemicals industry supports a huge amount of human life and human quality of life. Just things like fertilizers alone support billions of human lives. So shutting off the chemicals industry isn't really an option. We need to find a way to decarbonize while maintaining the business. And this brings us to the key question. How will the chemical industry evolve in the face of the energy transition? So this is our carbon canvas, and it measures our company's resilience to carbon pricing and their ability to invest in decarbonization. We're going to be looking at two key metrics. The first is the critical carbon price. This is the gross profit minus a 10% margin on sales. And we take that margin on sales out because we think that that is sort of a minimum threshold for maintaining the business. If you're not achieving at least a 10% minimum margin on sales, your business is really underperforming. So we take that out, and then we divide the remainder by the Scope 1 carbon emissions. This gives us the critical carbon price. Essentially, if a carbon tax was enacted at this price, your company would no longer be profitable or would fall below that 10% margin on sales. A couple key points here. One is we're focusing on publicly available disclosed information from public companies. Two, we're focusing on Scope 1 carbon emissions. This is both because it is the most commonly disclosed kind of carbon emissions, but also it's because it's the most accurately and well understood type of carbon emissions. So this critical carbon price measures a company's resilience to carbon pricing. Then we're going to look at the available capital from sales. We'll take that same gross profit minus 10% margin figure and divide it by the total revenue. This will give us a measure of the company's cash flow, available cash, I should say, as a percentage of that total revenue. This measures their capacity to invest in decarbonization, and indeed to potentially divest from their current asset base. We map these two figures on the horizontal and vertical axis here, and we've set two useful benchmarks. The first is a $200 per ton carbon price. We think that this is the highest realistic carbon price we'll see in the next 10 years. If you're below this benchmark, carbon pricing is a real threat to your business. The second benchmark is a 20% available capital from sales. We think that if you're above this 20% available capital figure, you've got some flexibility to potentially divest from your existing asset base. But if you're below it, you're really locked into your existing assets. Okay, how does the chemicals industry stack up? Well, on a high level, things are okay. There's a pretty good distribution of critical carbon prices from maybe $100 to $1,400 or higher. And even the companies who are in this bottom left quadrant are still relatively high on critical carbon price. If you were to look at the, for example, cement or steel industries, you would see companies that are in a 10 or 20 or potentially even lower critical carbon price range. In terms of available capital, however, the chemicals industry generally is doing a little bit worse. Most of these companies are below our 20% threshold. We can see that there are three evolutionary categories of companies jumping out at us from this group. The first in the bottom left, then we have this middle group of companies in the sort of $400 to $1,000 range. And then there's actually a third category of companies who are not yet pictured on this chart. And let's start with those. If we extend the carbon canvas out to $8,000, we find group 1. These are our least concerned species, companies who have transcended carbon pricing risk and energy transition risk, either by luck or by design. A lot of these companies are really focused on products and business models that inherently don't have high Scope 1 emissions. And remember, we're focusing just on Scope 1 emissions here. A company like Nippon Paint, for example, really purchases the overwhelming majority of its materials and formulates them and sells them on. This just doesn't generate that much emissions, even though there's a large Scope 3 emissions contained within those materials it's purchasing. DSM really stands out as having completed a transition to primarily focus on sustainable bio-based materials. Scope 3 pricing is a potential risk here, but overall, these companies should still probably be fine. In DSM's case, their Scope 1 critical carbon price is around $3,900 per ton. If you price them in Scope 3, it would fall to around $390 per ton. That's obviously substantially lower, but it's still above our $200 per ton benchmark. So these companies are going to be most at risk from other regulatory factors, things like materials of concern regulation. This brings us now to our group 2, transitional life forms. These are companies who are going to be under pressure to split up to survive. These companies all have relatively high critical carbon prices. So, in this $400 to $600, maybe $800 range. So they're not going to be under direct pressure to decarbonize. That is to say, it's unlikely that regulations are going to force them to decarbonize. But a lot of these companies are conglomerated or diversified chemical companies. They have a performance segment and they have a more of a commodity segment, maybe producing commodity plastics or inorganic chemicals. And the emissions are often highly concentrated in just a small number of those segments. So for these companies, decarbonization will effectively mean transferring money from those relatively low emission segments to invest in lower return on capital technologies in those high emission segments. And that's going to be very challenging to do. We expect to see a lot of shareholder pressure to break these companies up. You can imagine splitting one of these companies into a performance co, which will have much higher critical carbon price, and an emissions co, which will have a much lower critical carbon price. The performance company will be in a much better position to return value to shareholders because it won't be saddled with the emissions from emissions co. But the emissions company isn't necessarily in a better position to actually decarbonize. So this type of investor pressure could really delay our decarbonization efforts. Group 3 are our potential asteroid victims who are under a real risk from carbon pricing and need to evolve in order to survive. Now, you might be surprised to see companies like Solvay and Dow down here. These companies have very proactive CEOs who are really focused on sustainability. Their position in this lower part of the chart is not a reflection of a failed strategy. Rather, it's just a structural fact of their business and the types of materials and chemicals they produce. But still, under a Scope 1 carbon emissions pricing framework, these companies are at risk. You already see groups like Dow investing in, for example, mechanical recycling. This is a great technology because not only can it reduce the carbon footprint of polymer production by around 50%, it's also very capital light. And it's a good fit for these companies who don't have a lot of available capital from sales. However, there's a real threat here from groups like ExxonMobil. A company like ExxonMobil not only has a higher critical carbon price, again, we're focused on Scope 1 emissions here. Don't ask about the Scope 3 emissions from ExxonMobil. But they also have a lot more cash, especially in a year like 2022 with really high energy prices. A group like ExxonMobil not only has the size, but it has the available cash to either buy up these more commodity producers or invest in those low ROIC technologies, things like carbon capture and sequestration. They also have a much higher incentive to keep those petrochemical feedstocks in use. So companies like Dow are forced to invest in technologies that weaken the value of their asset base, while companies like Exxon can strengthen the value of their asset base. It's going to be very difficult for these companies to compete with these bigger, better financialized oil and gas players. So I think we've seen here today that decarbonization is really a very fundamentally challenging type of issue. And it's not really a question of technologies. There are good technologies in both the decarbonization side and the accessing new market side. And there's a strong startup ecosystem developing these technologies in both scenarios. However, there's issues here with the corporate structure You know, there's not really a established corporate structure that is empowered to do deep decarbonization in the chemicals industry. You have some groups focusing on operational enhancement, but they're really more tinkering around the edges, and they're not able to set strategy. You compare that to new business development functions, which are very well established in the chemicals industry and have a lot of strategic leeway to target the materials and opportunities that they think are best. The financial incentives are also not really there on decarbonization. As we've seen, for most companies, things like carbon taxes are not going to be high enough to force them to decarbonize. Compare that again to accessing new markets, and there's a very clear financial incentive. Chemical companies have grown by accessing and developing new markets, and it's a very well understood and very well established route to increase the value of the enterprise. So, how can the chemical industry then evolve in the face of these pressures, in the face of this energy transition? And in particular, how can it solve some of these organizational and financial issues with better structure? I want to highlight 4 paths or options that different companies can take. The first is nationalization. Nationalization, we often think of a utility, a company who invests in relatively low return on capital infrastructure that provides useful services in the public goods, be that water infrastructure or something like rail. This is clearly a fit to solving some of these financial issues, as a nationalized company could have the leeway to invest in some of those lower return, more sustainable technologies. But there's also an opportunity, I think, for nationalization to help some of that structural challenges as well. There's a lot of examples of state-owned enterprises like Saab or Dong Energy really being at the forefront of implementing sustainable technologies. A second object or opportunity is fragmentation. Take those deep decarbonization challenges and spin them out into their own companies. There is a lot of investor desire to invest in sustainable technologies. And if you can position the company in the right way, you could potentially raise the funding and get the right shareholders to invest in those spaces. Now, it is going to be challenging because of the lower returns on capital, but I think there is a potential appetite for this type of opportunity. The third option is kind of the polar opposite, further centralization, trying to build the biggest organization you can here and use those profits from the relatively low carbon intensity businesses and materials and chemicals to fund the decarbonization of those more emissions intense areas. We've talked a lot about activist investors during this presentation, and often in the context of wanting to split companies up and maximize shareholder returns. But it's not clear that that's the only thing investors want to do. When you look at the activist investors who recently took seats on ExxonMobil board, they were trying to push them to do more sustainability, not less. And there's a lot of investors who have a thesis that, while maybe it's lower return in the near term, decarbonization should have higher relative returns in the long term. The last opportunity, or potential threat, I should say, is from obfuscation. Companies who focus on essentially buying up old assets, wringing as much return out of them as possible while investing as little in them as possible before ultimately shutting them down. We already see this in the US in the energy space with companies like Diversified Energy, who buys up old natural gas wells and extends their lifetime. This has the side effect of also extending the emissions and the amount of climate change that's being caused here. So this type of outcome is really not ideal in our opinion because it goes against the need to decarbonize. But we do expect to see more private actors emerge whose focus is on operating as cheaply as possible and avoiding the costs of decarbonization. All of these options are potentially on the table. The goal of this webinar is not to tell you exactly what's going to happen to each and every single company, because it's going to depend on a lot of factors. regional factors, regulatory, the feedstocks that are available, and the technologies and products that are in use. But I want to leave you with this. These are some of Darwin's finches, a group of around 18 different species of finches that Darwin discovered during his trip to the Galapagos Islands. And you can see that they're all quite different. They've adapted for different ways of surviving. You've got the one on the upper left with its big beak. That's good for eating hard nuts. Then you've got the one on the bottom right, which is much more suited to eating softer fruits. Even in the small environment of the Galapagos Islands, there was evolutionary pressure and different opportunities to support a really wide range of different species. And in the same way, I think there's going to be a really wide range of different chemical companies who become adapted to their technologies, their structures, and their regulatory environments. But what's not pictured here are the finches who failed to evolve, who ultimately were not able to adapt to their environment and did not make it to the time of Darwin's visit. So remember, when it comes to the energy transition, it's better to evolve than to go extinct. And with that, I want to thank you. I want to highlight that we have an upcoming webinar on oil and gas scenarios, surviving the energy transition. And this is really tackling a lot of the same challenges from a different perspective, from the oil and gas perspective. And now we can open it up for questions.
Yeah, absolutely. Thanks, Anthony. And we do have a number of good questions to address here. A couple of those are about the scope 3 emissions. So you showed how DSM would be affected on the carbon canvas if you factored in their scope 3 emissions. So one simple question is just first off asking if we could do that for the other companies as well. And the answer I think there is we would love to, but most companies do not report the scope 3 emissions, in large part because most companies do not know their scope 3 emissions, right? That level of reporting across the value chain is just not present yet in most cases.
Yeah, that's right. I think, for most companies, you're looking at typically a critical carbon price in scope 3 that's at least 25% lower than their scope 1 critical carbon price. And for some companies, it's much, much lower. If you look at a company like Nippon Paint, I mean, their emissions are overwhelmingly scope 3. So, there are companies who will be very affected by that pricing if that does come to pass. But like you said, the scope 3 data isn't really available. We don't really have standardized methods for that. And we don't really expect scope 3 pricing to become the law of the land anytime soon, certainly not within the next decade. So for now and for the foreseeable future, scope 1 pricing is really going to be the thing that is going to end up being regulated.
Yeah, but I think, and this relates to one of the other questions, like the scope 3 emissions can be different things, right? ExxonMobil, when you talk about their scope 3 emissions, right, it's largely downstream, what happens to their product after they sell it, right? You burn the gasoline or whatever, and then that's a lot of the emissions there. But as you pointed out, for the companies like Nippon Paint or whatnot, their scope 3 emissions are mostly upstream in their supply chain, their suppliers, their raw materials. And that is going to be affected, right? It's not, they're not going to obviously have to directly pay for or directly make the capital investments necessary maybe to decarbonize those inputs. But if their suppliers are forced to pay that carbon price or invest to decarbonize, that is going to impact these companies in terms of just what it costs them for the raw materials, right?
Yeah, I think these companies, sort of who are mostly purchasers of materials, do have some incentive and some opportunity to invest in decarbonization. But I think it's really from the perspective of supply chain risk. Well, like you said, the regulations are not going to be strong enough to incentivize them to decarbonize directly. But, a lot of these companies may only have a handful of key suppliers. And we've seen that there's climate change risk. There was a disruption to nylon supply last year, for example. And a lot of companies maybe only have one or two key suppliers, or all their suppliers are in a specific geography. So in these types of scenarios, these companies can use a new sustainable feedstock or a new supplier of a sustainable decarbonized material as a risk hedge. And you only need to replace maybe 10% of your existing feedstock supply in order to both have a pretty solid hedge against disruption, but also a capability to potentially leverage and negotiate against price, right? It doesn't take much to
Mhm.
create some leverage there. So there are definite opportunities for decarbonization for those companies with those higher critical carbon prices. But I think they're really much more focused on risk management and potentially brand consumer facing reasons rather than you know direct impacts on company profitability.
Yeah. Yeah, and I think it also, there's another question related that I think also further builds on this with the question about the value chain positioning, right? You talked about how companies might be incentivized to break apart, or they might be incentivized to centralize potentially in some scenarios. But what do you see as far as these creating incentives or disincentives for companies maybe to move up and down the value chain? So, like you said, maybe Nippon Paint's customers or suppliers might choose to move down the value chain as part of their own carbon mitigation strategy into the formulation stages that, as you can see from their critical carbon price, are less carbon intensive. Or you see companies like BASF getting into 3D printing and sort of moving closer to the end product, and that way, do you see those type of moves as being well, of course, the ExxonMobil example is all about that, right? They're moving down. The perspective threat there is them moving down the value chain from petroleum into chemicals.
Yeah,
So how do you see those shifts playing out potentially?
ExxonMobil is already, I think, the largest producer of plastics in the world. I
Right.
do think you're going to see a lot of companies move down the value chain. I mean, it just makes sense if you're prioritizing your new business development to prioritize, healthcare materials, to prioritize high value engineering plastics, these things that don't really need to decarbonize, frankly speaking. But the reality is that someone is going to have to produce those uh, fundamental petrochemicals, right? For something like fertilizers, ammonia, there's not really a ton of opportunity to move down the value chain per se. Um, we really
Start
need,
growing corn or something. Yeah, not really.
yeah, I mean, we really do need, nitrogen fixation, right? Like the nitrogen has got to be pulled out of the atmosphere. And whether it's an oil and gas company doing that or a chemical company doing that, someone is going to have to invest in that and invest in decarbonizing that. So not everyone can move downstream, right? We can't just have everyone produce engineering plastics and abandon, things like fertilizers. So someone is going to have to invest in these lower return technologies, and they are going to be lower return, right? Frankly, um, if they were higher return, people would already be doing them. It's just that simple. And it may be true at some point in the future, they will end up being higher return as the technologies develop and as the legislation develops. But in the next decade, when we really need to make the huge progress on this issue of decarbonization, these technologies are still going to be lower return than just not decarbonizing. So that's the challenge, and that's where a lot of this fundamental tension comes from.
And finally, Tom, I think for one more question here about the question of how the chemical industry will evolve. This says the approach you're hypothesizing is that this is occurring in an absence of regulation. I'm not sure if you would agree that with that characterization of your analysis, but the question I think pertains, right? If regulation occurs in different regions in different ways, how does that affect this landscape, this analysis?
Yeah, I mean, I think everything here is fundamentally driven by regulation. Like carbon price is regulation, right? Um, and a lot of the other elements we talked about, things like nationalization versus privatization, and sort of the evasion of those emissions regulations. That's all regulatory driven. There's a lot of different things we could talk about here. What I would highlight is two things. One is, there's a regulatory approach focused on making the cost of emission more expensive. That's what you see in Europe with carbon taxes, versus an approach that makes the cost of decarbonizing cheaper. That's kind of what we're seeing in the United States with the Inflation Reduction Act providing a lot of funding and a lot of support for decarbonization. So, that can incentivize different things. And I think ultimately increasing the costs of decarbonization are going to lead to probably quicker outcomes because it makes those increasing the cost of emitting carbon. So what the EU is doing, I think, is ultimately going to lead to quicker transition because it's going to make those highly emitting businesses less profitable. And ultimately, some of them are going to need to be shut down. The other thing I would highlight is there's a lot of opportunity for international fragmentation here. Even if everyone agrees on, decarbonization or a global carbon tax, which is not necessarily super likely, you could have a scenario in which people are calculating sustainability, calculating carbon taxes, defining them in different ways. We don't have a single method for an LCA, for example. So there could be a lot of disagreement between regions or between countries on what is sustainable. And this can create, just an additional layer of friction on value chains that are already under a lot of stress. So you could see further, onshoring, further breakdown of international sort of shipping and trading of various products. We've already seen breakdowns of like recycled product trading, for example. So it's entirely possible that this pressure to decarbonize and the regulations could really increase the friction in the global economy.
All right. Well, thanks, Anthony. That wraps up the webinar for today. All the attendees will get a copy of the slides and a recording through email later on today. After you leave the webinar, you will get a survey. We really appreciate any feedback you can give us there. We look at those very closely and use that to try to improve our webinars and select topics and so on. So please take a moment for that. And as Anthony said, some of these upcoming webinars I think are very likely to be of interest if you enjoyed this one. So look at those as well. Thanks again for joining us and have a great rest of your day.